Want to know the secret to successful investing in 2024? Well, what if I told you that you could learn from one of the greatest investors of all time? Enter Warren Buffett, the Oracle of Omaha, a man whose name is synonymous with success in the investment world. With a net worth that dances in the billions, Mr. Buffett's strategies have consistently proven their worth over time. In today's discourse, we're going to uncover the 7 golden rules Buffett swears by in his investment journey. From the importance of long-term investment to the art of seizing opportunities when they arise, these rules are the pillars that uphold his investment empire. They are not just rules, but philosophies that can guide you in making informed and strategic investment decisions. This is not just about investing, it's about cultivating a mindset that opens doors to wealth and financial freedom. Now let's dive into each rule to understand how they can change your investment game. First up, it's all about the long game. This is Warren Buffett's first golden rule. Don't buy a stock if you're not willing to hold it for 10 years. Now, why is that? Well, it's simple. Investing isn't about quick wins or overnight successes. It's about long-term growth and stability. Think about it like planting a tree. You don't expect it to bear fruit in a day, a week, or even a year. It takes time. And it's the same with stocks. When you invest in a company, you're buying a piece of that company's future. You're betting on their long-term success, not their short-term fluctuations. Consider the case of Amazon. Those who invested in its early years and held on to their stocks are now reaping massive rewards. But it didn't happen overnight, so the key takeaway here is to be patient. Let your investments grow. So remember, patience is a virtue, especially in investing. Next, Warren Buffett's golden rule: don't lose money. Simple, right? But how do you actually avoid losing money in the unpredictable world of investing? Buffett's answer lies in the concept of intrinsic value. Intrinsic value is the inherent worth of a company based on its projected cash flows, assets, and earnings. Buffett suggests investing in undervalued companies, those whose market price is below their intrinsic value. By doing so, you're buying $1 for less than $1, which minimizes your risk of loss. Consider the case of Coca-Cola in the late 80s. Buffett noticed the company's strong brand and loyal customer base, which were not reflected in the stock price. He invested heavily, buying low, and as the market recognized Coca-Cola's true value, the stock price soared. In essence, the key is to buy low and sell high. This strategy not only prevents losses, but can lead to significant gains. Remember, as Buffett says, rule number 1, never lose money. Rule number 2, never forget rule number 1. Now let's talk about the importance of doing your homework. You see, in the world of investing, research is not just a recommendation, it's a rule. A cornerstone of making sound investments is understanding the company you're investing in. Warren Buffett himself places a great emphasis on this rule. So how do we go about it? Well, one crucial aspect to look at is a company's cash flows. Cash flow is the lifeblood of a business. It's the money that flows in and out of a company. Positive cash flow indicates that a company's liquid assets are increasing, enabling it to settle debts, reinvest in its business, return money to shareholders, pay expenses, and provide a buffer against future financial challenges. Conversely, negative cash flow could be a sign of trouble. So before you invest, take your time to understand a company's financial health by checking its cash flows. Because in the end, it's not just about making money, it's about making informed decisions. Remember, knowledge is power. Before we dive into the next rule, let's take a moment to connect. Are you enjoying the video so far? We hope these rules are providing you with valuable insights into Warren Buffett's investment strategy. If you're finding them helpful and want to continue learning from the best, why not hit the subscribe button? By subscribing to our channel, you'll get access to more videos like this one, helping you become an expert investor just like Buffett. And don't worry, we're not going anywhere. We still have plenty more rules to share with you, so stay tuned, hit that subscribe button, and let's continue with our journey into the mind of one of the world's most successful investors. Now, back to the rules. Moving on to Rule 4, it's all about the profits. Warren Buffett's 4th rule emphasizes investing in companies that generate more money than their stock is worth. It's not just about the current value of the stock, it's about the company's ability to generate sufficient cash over time. So how do you identify such companies? Look for businesses that have a consistent track record of profitability. Those that consistently increase their earnings year after year are likely to be generating more money than their stock is worth. Take, for instance, a company that has increased its earnings by 10% every year for the last 5 years. There's a good chance that company is generating more cash than its stock price suggests. Remember, the key here is to look beyond the stock price at the actual profitability of the company. It's the cash that counts, so always keep an eye on the cash. Next up, let's decipher the world of interest rates. Interest rates, you see, are the cost of borrowing money. They're a critical element in the world of investing. When you lend money to a bank, the bank pays you interest. The same principle applies to companies. When you invest in a company, you're essentially lending them your money with the expectation of a return, typically higher than what a bank would offer. Now here's where it gets interesting. You need to analyze whether the companies you're eyeing can provide a return higher than the prevailing interest rate. If not, you might as well put your money in a bank. But remember, don't get lured into businesses you don't understand, no matter how attractive the interest rates might seem. This rule is a crucial reminder to always stay within your circle of competence. If you don't understand how a business operates or how it makes money, it's best to steer clear. In conclusion, if you don't understand it, don't invest in it. Now let's learn how to go against the tide. This is the 6th rule from Warren Buffett's playbook, and it is all about being contrarian. In the world of investment, it often pays to be different. When everyone is buying, that's usually the time to sell. And when everyone is selling, that's your cue to buy. This rule is based on the fundamental principle of supply and demand. When demand is high and everyone is buying, prices rise. But when demand is low and everyone is selling, prices fall. So, by being contrarian and doing the opposite of what everyone else is doing, you can often get a better deal. Take the dot-com bubble of the late 90s, for instance. Many investors lost a fortune because they followed the crowd and bought into the hype. But those who were contrarian and sold their tech stocks before the bubble burst made a killing. So don't be afraid to go against the crowd. Lastly, let's discuss the art of seizing opportunities. This is the 7th and final rule from Warren Buffett's investment playbook for 2024. Opportunities in the world of investing are like buses. There's always another one coming. But the key is to know when to hop on. This requires a keen eye, a bit of courage, and a whole lot of patience. Opportunities could present themselves in various forms. It could be a groundbreaking innovation in technology, a shift in consumer behavior, or even a global crisis. When the rest of the world retreats, that's your cue to advance. It's about identifying potential where others see peril. Let's consider the dot-com bubble burst of 2000. Many investors were scared off, but those who seized the opportunity to invest in resilient tech companies reaped enormous rewards. So, stay alert, stay informed, and when the right opportunity comes knocking, don't hesitate. Remember, fortune favors the bold. So there we have it. Warren Buffett's 7 rules for investing success. A compendium of wisdom that has stood the test of time, guiding one of the most successful investors in history. Rule 1, the long-term investment strategy, reminds us of the importance of patience in the world of investing. It's not about quick wins, but sustainable growth over a decade or more. Rule 2, avoiding loss, emphasizes the need to buy below intrinsic value. It's all about finding those hidden gems, the undervalued companies that can provide a significant return on investment. Then we have Rule 3, the necessity of thorough research. This rule underscores the importance of understanding a company's cash flows and its potential to generate money in the future. Rule 4, investing in profitable companies, further accentuates the importance of cash. It's crucial to put your money in companies that generate more than their stock is worth. Rule 5, understanding interest rates, highlights the need to invest in companies that can provide better returns than banks. This rule also cautions against investing in businesses you don't understand. Rule 6, being contrarian, encourages us to be brave and step away from the crowd. Buy when others are selling, and sell when others are buying. It's about exploiting the market's mood swings for your benefit. Finally, Rule 7, seizing opportunities, urges us to be agile and ready to pounce when the right opportunity presents itself. These 7 rules are not just principles. They are a roadmap to successful investing. They are particularly relevant in 2024, a year filled with opportunities and challenges. Whether you're a seasoned investor or a novice, applying these rules can help you navigate the often tumultuous waters of the investing world. With these rules in your arsenal, you're ready to conquer the investing world. Until next time, invest wisely. Thank you for joining us on this insightful journey through Warren Buffett's rules for investing. We hope that these principles have not only added value to your investment strategy, but also given you a new perspective on how to approach the market. Remember, investing isn't a gamble. It's a game of skill, patience, and knowledge. If you found these insights helpful, please consider subscribing to our channel. We aim to provide you with a wealth of information to help you become an expert investor. We deliver content on various investment strategies, market trends, and tips from successful investors like Warren Buffett. By subscribing, you'll get notified every time we post a new video, ensuring you never miss out on essential investment knowledge. And finally, as we conclude today's video, we leave you with this thought. Investing is not a sprint, but a marathon. It's about consistency, not speed. So, until next time, invest wisely, stay patient, and remember Buffett's rules. Thanks for watching.